Welcome to Sectors Up Close. I'm Elena Casas. We're focusing today on UK equities, and my guest is Dewi John, Refinitiv Head of Research for the UK and Ireland. UK equities have underperformed their global counterparts consistently for the last decade, with a compound annualised growth rate of just 7.3% over the last 10 years. This year, though, they seem to have changed their tune. The FTSE 100 has gained about 2% year to date, when almost all its European peers are down, and the S&P 500 has had the worst first 4 months of a year since 1939. Some of that strength is down to what's in the UK indexes. The FTSE 100 and FTSE 350 are weighted towards financials, materials, mining, and especially the energy giants, the stocks that have benefited from soaring commodity prices in the wake of the war in Ukraine. But companies reliant on the financial health of the British consumer are looking at a different picture as the country faces a squeeze in the cost of living, brought on in part by those high oil prices. Annual inflation has hit 7% and consumer confidence is near record lows. Last week, official data found almost a quarter of Britons were struggling to pay their energy bills. In an attempt to rein prices in, the Bank of England again raised interest rates this morning, giving a bleak forecast for the British economy.
UK GDP growth is expected to slow sharply over the first half of the forecast period. That predominantly reflects the significant adverse impact of the sharp rises in global energy and tradable goods prices on most UK households' real incomes. It is a measure of the scale of the shock that total real household disposable income is projected to fall by 1.75% in this 2022, which, apart from 2011, would be the largest contraction since comparable records began in 1964.
So, what does this mean for UK equities? To find out, I'm now joined by Dewi John, Head of Lipper Research for the UK and Ireland at Refinitiv. Dewi, hi.
Hello.
To start with then, why has the FTSE 100 performed better than counterparts this year? How much is just down to these soaring gas and oil prices?
Well, you kind of stolen all my best lines because I could witter on about value versus growth effects and the UK being a more value-based index and that having come out of a long period of underperformance, yada, yada, yada. But the reality is it is oil and gas. If you look at the FTSE 100, it's got about 10% plus, near 12% in this area. The S&P's got about 4%. The DAX has got virtually nothing. And actually, if you look at the UK mid-cap indices, the 250, it pretty much goes in lockstep with what's happening with the DAX. So it's a bigger oil exposure, in short.
But we are now seeing, of course, the impact of inflation on consumer behaviour here in the UK. I know that much of the FTSE 100 is globally orientated, but how much is this an issue for equities?
There's a lot of research on the impact on inflation on equities. Over the long run, it will tend to outperform, but the reality is it's very confused. There aren't any clear messages coming through. You want to be in equities more than you do bonds at the moment, certainly, but I think you need to be picky about what sectors you're exposed to. Those with significant oil and gas exposure over the past few months will, of course, be pretty happy with that.
But when you say picky about what sectors you're exposed to, does that mean we should start to be concerned about companies that are very exposed to the UK consumer?
Oh yes, yeah, and the UK, I mean, although inflation is hitting everybody globally at the moment to different degrees, the UK consumer is one of the most exposed to them. If you think about it, in France, they put an energy cap of 4%, whereas we know here, anytime we open our energy bills and wince, we've got nothing like that here. Also, in terms of some kind of welfare safety nets, they're more generous and more supportive in the continent than they are in the UK. So that leaves the certainly lower earners very exposed. But again, it's which sector or which segment of the consumer market that you're going to talk about. And I don't think you can generalise too much about that.
Financials are a significant part of this index, and of course this morning the Bank of England has raised rates another 1/4 point. How do you think the current environment is going to play out for the big British banks?
Well, a rising rate environment should be good for banks. And indeed, when I was speaking to fund managers, UK equities in the early part of the year, and I said that even one or 2 months ago, the two sectors that they were particularly bullish about were, of course, energy and, secondly, financials. People are a lot less enthusiastic about financials now, despite rising rates, and the reason for that is banks, alongside other financials, are very, very pro-cyclical. And if rising rates causes us to go into recessionary mode, then banks are going to suffer. So it's there's a lot of talk here at the moment about positioning the economy for a soft landing, and these things hardly ever work. As soon as you hear soft landing, you're kind of in trouble. So the shine has very much come off banks over the past month or so, I think, if not before.
So given the difficult balancing act the Bank of England faces in order to try and engineer a soft landing, how should investors be approaching UK equities?
Carefully. Inflation isn't necessarily a bad thing for equities. Rising rates aren't necessarily a bad thing for equities, but choked off economic growth certainly is, and stagflation, which we might be looking at, is, and equities will be punished then. So the areas of the market you want to look at are those that aren't too exposed to the consumer, as we've already discussed, and that have pricing power. Outside of equities, of course, assets that do tend to perform well in a stagflationary environment are real assets such as real estate and commodities, and they could be worthwhile a look at in this environment, or the companies exposed to them.
Well, thanks so much for that insight, Dewi John, Head of UK and Ireland Lipper Research at Refinitiv. Well, before I go, here are some of the stories we're following in this space. Shell is the latest UK-traded oil company to report soaring earnings today of more than $9 billion in the first quarter. Adjusted earnings are up 43% thanks to those higher oil and gas prices. Shell, like its global peers, has done well as the Ukraine crisis pushes up energy prices. Yesterday's EU decision of a phased ban on Russian oil is likely to send them even higher. The high street giant Next provided some reassurance that cash-strapped Britons are still shopping. It reported a 21.3% rise in sales from its 500 stores and online in the fiscal first quarter. It kept guidance for full-price sales to increase 5% this year. And Britain goes to the polls this Thursday in local government elections dominated by the cost of living crisis and fines received by Prime Minister Boris Johnson for breaking his own COVID-19 lockdown rules. A poor result will increase pressure on Johnson, who last month became the first British leader punished for breaking the law while in office. Calls for his resignation have been growing for months, and a bad night for the ruling Conservatives could lead his own MPs to move against him. And that's your roundup of the UK equities sector. I'm Elena Casas, and this is Reuters.